some things. So keep Wipro at the back of your mind. And from among stocks, I think PFC was something that she recommended. But we brought up IT with her because it's a great lead into the next conversation that we are having with Abhishek Kumar. He tracks IT services at JM Financial Institutional Equities and joins us right now on the show to talk about, well, what's really happened. Abhishek, good having you. Thanks for joining in. And it took me by surprise, but in the morning when I saw the kind of reactions that we did to most of the IT names, and then when we are just trying to dig a little bit further into it, one of the, our understanding was that that the index had been beaten down so badly, and Infosys did not speak about projects getting pushed the way TCS and Wipro might have, and maybe that could have been one trigger. But I'm just trying to understand from you, what explains this frenzied move in IT today?
Yeah, hi, good afternoon. Thanks for having me here. So yes, Infosys did not talk about cancellations or pauses. See, there is one thing. We have three results so far: TCS, Wipro, and Infosys. There is one common theme, that I am sensing. That is that while near term, maybe a quarter or so, the visibility is uncertain, but none of the players sounded any alarm when it comes to full year or medium term. Right? None of them have seen cancellations. It is mere pauses. One such example is Wipro, when they said that one large SAP program has paused. Now, SAP implementation can only be paused. It can't be, it's unlikely to be cancelled because the end client might have already paid for the license. So these are, classic example of pauses which can go away, once some uncertainty lifts in the environment. And Infosys was the first one to give a full year guidance, and their guidance, in my view, is actually encouraging. That's what we wrote in our note also. Encouraging yet realistic. Encouraging because if Infosys had met its 4Q expectations, the guidance for the same CQGR that their guidance is implying now could have taken the guidance up to close to 3 to 5%, which is what our expectations were. So that means there is no material deterioration from the pre-tariff view that we had, which is built into at least the quarterly, growth cadence that they are building in their guidance. So that's encouraging, and we think it is realistic because if you look at their last year deal wins on a net new basis, it was $6.5 billion of net new deals which they won. They also indicated on the call that the deal tenures have come down. That means the conversion would be faster. And at 0 to 3%, the incremental revenue they are building in their guidance is just $0 to $600 million against a net new deal wins of $6.5 billion. So I think it is realistic, achievable, and it kind of puts a floor to the expectation, given this is the first one which has come out with the full year guidance. So looks like everyone is building in, things to stabilize or improve as we move through the year.
Point taken, Abhishek. Harsh also joining in. When I'm looking at valuations, Abhishek, when I'm looking at past averages, stocks don't seem to be trading at a deep discount to past averages. So correct me if I'm wrong. That the move that we're seeing today is largely just on the back of some bit of positivity that's starting to get built in versus what was earlier anticipated.
Yes, you're right. So in terms of valuation, let me first tackle that. Companies like Infosys, TCS are trading close to their 10-year average multiple. Yes, not at a discount. If we take last 5-year average PE ratio, then they are trading almost at one standard deviation below the 5-year average. So may not be at discount to long-term averages, but not expensive also. I would say they are reasonable. And if the kind of guidance which Infosys gave, if that kind of gives some visibility in terms of where the earnings could land up, that should give confidence to the investor that earning downgrades from here probably would be limited. And with valuations at 10-year average, etc., the risk reward seems then favorable.
And what you make of the downside risk to this, Abhishek? Because oftentimes in the last year or so, we've seen some bit of positivity with regard to commentary, which has been recognized by the street. But thereafter, the factors that follow in terms of a rate cut, it has tended to get pushed. In terms of demand recovery, that too has been weak and fleeting. Do you believe that some of those factors still are elusive to a large extent?
See, I look at it this way. If we look at the deal wins by some of these players, whether it is TCS, Infosys, and Wipro, because that's the only tangible data points that we have to build our revenue forecast for future. And all three of them have done very well in terms of deal wins last year. One can argue that Infosys deal wins in FY25 was weaker than FY24. But FY24 was a record year. But on a standalone basis, all three of them have done very well. So their order backlog, in my view, is very strong. Getting into this uncertainty compared to when they went into COVID. So that should give some visibility into revenue. Yes, discretionary spend might get pushed out, but with where the valuations are and expectations are, I don't think Street is building any uptick in discretionary spend anyway. If that were to come, that will be an added upside.
Okay. Abhishek, now the one thing that came out in the commentaries was that I think at least in Infosys, I distinctly remember having seen that they mentioned that the European auto sector is looking weak. I'm changing tracks here a bit, but they said that the European auto sector has looked weak. We know, there is telltale evidence to suggest that there might be issues there. What happens to ER&D? And I don't just mean a KPIT, which is only automotive, but some of the others also have a large automotive presence, right? And Europe forms a bulwark there, if I'm not wrong. So what happens to ER&D earnings and possible commentary? How would you, as somebody who tracks this space closely, think of the ER&D stocks for the near term?
Yeah, so look, across the board, ER&D stocks have taken a beating over the last, 4-6 months, ever since, European auto OEMs started flagging off some challenge. So that is not new. A lot of it is in the price. KPIT has come down from its high of 1900 to now less than 1200. There are two ways to look at this challenge. There is no denying that auto OEMs in Europe and maybe in US also are under a lot of pressure, more European OEMs. One is the direct impact is, they cut down their R&D expenses, which they have talked about. Their R&D expenditure probably peaked in calendar 24. But on the flip side, these kind of crises, and as for us who track outsourcing companies, the wave of outsourcing always have been triggered by some or the other challenges at the end client's market, whether it was Y2K, whether it was GFC in 2008. And I think auto ER&D, where the outsourcing penetration is still single digit, there is a huge scope of more outsourcing and more offshoring. Whatever outsourcing has also happened in this space so far has gone to a lot of nearshore players who are in and around Germany and France, etc. A lot less share comes to India compared to IT services. I think that can change because they have no other choice but to reduce cost and still do R&D, which is good quality at scale and lower cost. So India provides a very good alternative. So I see this as this not as a threat but as an opportunity. It might play out maybe over the medium term. But I think clearly the outlook from a medium to long term perspective is very good for the ER&D plays.
Mm-hmm. Okay. Are you making? We were. Somebody in the morning was an editorial discussion was making a point about maybe large caps per se, ER&D plus IT services, large caps. The near-term bottom may have been formed. Can't say the same for mid caps, small caps. Do you do a bifurcation like that, or is it very bottom-up, earnings specific?
Yes, I think the better way to do it is bottom-up right now. because especially mid caps, they have their own nuances. They are not as diversified as large cap. So we need to see what's happening with their verticals, who's exposed to tariff risks, etc., who has the momentum of deal wins behind them, execution, where the valuations are. So yeah, I would be more bottom up when it comes to mid caps.
So what within bottom up, Abhishek, if you can give us views and names?
Yeah, so in mid cap space, we like Hexaware. Hexaware, I think, has corrected below its IPO price. They in their first earnings call, they indicated two large consolidation deals that they have won in their top three accounts. And I think they're confident of double-digit growth this year. So I think from a valuation perspective, also Hexaware makes sense. So we like that in Hexaware. As we discussed, I like KPIT. That's more on the ER&D side. And Coforge also, after correction, looks good. They also have deal momentum behind them. So I think, yeah, these are some of the mid-cap names that I would prefer right now.
Abhishek, last question with regard to how AI, or your views with regard to how AI is going to disrupt the space in some fashion, in a large fashion. Will the AI winners be different? And how do you identify them? A difficult one, but if you have a view.
Yeah, so it's an evolving discussion, as you can imagine. I think there are two aspects to AI. One is the volume compression that we are seeing now, probably when everyone talks about productivity pass back to clients. Essentially, they are doing more with less, and therefore they are billing for less people. That is playing out now. But the other equally large, if not bigger, aspect is new use cases, new areas that can open up for IT services players. I think that has not taken any shape, or we cannot say with any degree of confidence that when that will start, if at all that will start. But my sense is that with AI getting into everything, it's a matter of time before the end clients of IT services players will find more use cases. There could be, some of the identified opportunities are something like legacy modernization, very old applications that have not been modernized because nobody knows what they do. And that can open up a large opportunity because AI makes it possible. So net, I think it would still be positive, but the way it is evolving looks like all the negatives are hitting the players first, and then the positives will follow. So that would be my view. I would still be optimistic about the scope of AI. I mean, just imagine when every single industry in the world is getting impacted by AI or becoming, more tech focused. The only industry I would worry about is IT services. Actually, there are other, like creative content creation or so many other industries, creative writing that can be cannibalized by, by IT services players. So IT is something I'll not worry about just because of AI.
Okay, not as worried with regard to AI, especially from an IT perspective. Thanks so much for joining us this afternoon, Abhishek. Good having your views on a day like this when IT has been a real mover. In fact, pulled off a bit of a blinder, if I can call it that. But what we'll do, we'll slip into a very short break. But before that, we'll leave you with our conversation with Mastech.